Welcome to S&P Capital IQ's European loan market video overview, detailing leveraged finance trends and activity during December 2011. I'm Suchit Gupta, a member of S&P's Capital IQ's leveraged commentary and data team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe before winding up with themes to watch for in January and early February 2012. Before we start, please know you can follow LCD on Twitter, Facebook, and can join the more than 7,000 contacts in LCD's leveraged loan group on LinkedIn. The links to follow LCD are in the info section on our YouTube channel. You can also download the slides for this video at slideshare.net. Before getting down to business, some fine print. This disclaimer, courtesy parent company Standard & Poor's and McGraw-Hill, covers all the bases. Please read it at your leisure. And now to the market. December was an uneventful month as both arrangers and investors wound up what was a tumultuous year. The secondary loan market finished the month up 16 bips at 93.46, but finished the year down 441 bips. The secondary high-yield bond market finished the month up 84 bips at 88.47, but finished the year down 952 bips. Loan issuance stood at $200 million for the month of December and $43.5 billion for the full year 2011. Meanwhile, the high-yield bond market had a read of naught in December 2011 and a read of 35.3 billion euros for the full year 2011. The S&P European Leveraged Loan Index, the LE, had a positive return of 0.38% ex-currency for the month of December 2011 and a full-year return of positive 0.36% again ex-currency. December was an uneventful month for the primary loan market with only $200 million of new issuance. The high-yield bond market had a read of 0 for the month of December 2011, and default rates also ticked up higher and are expected to rise in the new year. Focusing on the secondary loan market, this chart details the average price of LCD's European loan flow name composite, a measure of the 14 largest, most liquid loans consisting of 10 issuers since 2002. The flow names rose 16 bips to close the month at 93.46, but have finished the year down 441 bips. This next chart details the average price of LCD's European high-yield flow name composite, a measure of the 12 most liquid high-yield issues since the beginning of the year 2010. The high-yield market gained 84 bips during the month to close the month at 88.47, but has finished the year down 952 bips. This next chart details the monthly return of the LE, a broad measure of European loan market returns that LCD calculates. All returns are ex-currency unless otherwise stated. The European loan market posted a positive return of 0.38% for the month of December 2011, up from the negative 0.67% seen in November 2011. The total LE return for 2011 is a positive 0.36%, compared to a positive 8.39% for all of 2010. Now we turn from the secondary to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. December was an uneventful month for the primary market, as both arrangers and investors started winding down for the holidays and the new year. New issue leveraged loan volume for the month of December was just $200 million. For 2011, new issue loan volume stood at 43.5 billion euros. High-yield bond issuance was not in December 2011, and for the full year, high-yield bond issuance stood at 35.3 billion euros. The high-yield bond market has been in a slump in the last 5 months, as only 9 borrowers have accessed the market, raising 2.6 billion of paper. This figure stands in stark contrast to the preceding 4 months, April through July, when 56 bonds priced for a total of 18.2 billion euros of new issue volume. Given the volatile and difficult macroeconomic concerns, it's not unusual that the default rates have ticked up higher in December. The default rate by principal amount stands at 4.09% at the end of December, up from 3.91% at the end of November, and up from 2.54% at the beginning of the year, 2011. Meanwhile, the default rate by issuer count is now at 3.39% at the end of December, up from 2.99% at the end of November. In summary, and themes to watch for in 2012. European issuers tapping the U.S. capital markets. European borrowers will look to the dollar market in 2012 for both bonds and loans, with cross-border borrowers in particular opting to refinance credits solely in the U.S. market. The markets are still waiting for some kind of solution from the sovereign risk contagion and any potential changes in regulation. Banks will be wary to underwrite new transactions given the volatility in the market, coupled with their high cost of funding and the still significant overhang from 2011. Given the volatile/bleak macroeconomic conditions, most market participants still expect default rates to rise further in 2012. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including the U.S. loan market wrap-ups. The links to the page are in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.